Fannie Mae and Freddie Mac had to be effectively taken over by the government. 3 of America's 5 largest investment banks failed or have been sold off in distress.
Housing market collapse continues as we have our 5th straight week of nationwide median sales price decline. And we're going to ask the question, is that enough to guarantee a September rate cut? And is it possible for an emergency rate cut to happen before September? And not only that, guys, we're going to ask questions like whether or not the Fed is going to bail out the housing market in 2025. And I'm up early to give you guys this report in advance of Redfin coming out with their weekly housing market report. If you guys don't believe me, look at the timestamp on this video. I am giving you this report in advance, and I am super excited about that. Now, again, you guys, I think it's really important to ask the question whether or not the Fed is going to bail out the housing market, because they always do. And I'm going to play this Obama video for you, and I want you guys to answer and ask yourselves this question. Are we going to have a worse economic crisis than the GFC?
The news from Wall Street has shaken the American people's faith in our economy. The situation with Lehman Brothers and other financial institutions is the latest in a wave of crises that have generated enormous uncertainty about the future of our financial markets. This is serious. This is a major threat to our economy and its ability to create good-paying jobs and help working Americans pay their bills, to help Americans save for their futures and make their mortgage payments. Since this turmoil began over a year ago, the housing market has all but collapsed. Fannie Mae and Freddie Mac had to be effectively taken over by the government. 3 of America's 5 largest investment banks failed or have been sold off in distress. Yesterday, Wall Street suffered its worst losses since just after 9/11. We are in the most serious financial crisis in generations.
Comment below, let me know whether or not you think this collapse is going to be worse than the GFC. Now, before we really dig in, I want to give you guys this week's word. So if you're at a party and you want to talk about the housing market and sound super smart, make sure to use the word bifurcated. Bifurcated means the housing market is incredibly divided. And as you guys know, when I do these videos, I always try to make clear that we're going to go over macro data. What you really need to do is look hyper, super local, which basically means you got to analyze comparable data in subject properties, subdivision. So it's all about local trends. Regardless, this is what bifurcated means. We can essentially have markets like Texas that are exploding with inventory. Now, this graph goes all the way back to 2016, and this is the highest amount of active inventory for existing homes. We see similar explosion of inventory in states like Florida that are absolutely exploding as well. Now, this is the 5-year chart, and as you guys can see, we're well over pre-pandemic now, as again, Florida continues to explode with inventory. But remember, you guys, the housing market is incredibly bifurcated. And so we have states like New York that are well under pre-pandemic normals. But remember, you guys, it's also low inventory, so they don't need a lot of inventory to double. But regardless, you can see in this graph, this is a 5-year graph of active listings for New York. They're a long ways away from pre-pandemic norms. You can see really clearly here that New Jersey really never even rebounded, as they're well below where they were at pre-pandemic. Then the question is are we guaranteed to have a rate cut in September? And what I want to tell you guys, it doesn't matter. We already got our 75 basis point rate cut in mortgages. Remember, you guys, the federal funds rate does not directly impact mortgage rates. The 10-year does. So they've, from what I can tell, have already priced in that rate cut. You really got to think the foolish optimism of the market. But let me show you guys where we're at today as far as residential mortgage rates. Now, right now, you guys, we're sitting at a 6.05% with FHA, incredibly low, which means we're in the 5% with FHA. Now, if we look to the upper left, you guys will see I've highlighted 6.49%. That represents the bulk of the business for conventional mortgages. Remember, as a consumer, what matters is the pricing of your rate, or rather, how much does your interest rate cost? As a consumer, if you know and understand, that's what you really need to pay attention to, is how much the rate costs when you lock it in, then you're going to be ahead of the herd. Generally, you're going to get a better deal with a broker versus a lender, a lot of times because the operating expenses of a broker is much lower. And then one more thing, you guys, is generally if you're listening to what I'm saying, you have great credit, you're shopping your mortgage, you should get about a half a point lower, just my opinion, remember, than what you see there. So again, rates are already under 6%. Look at what the market is thinking is going to happen now in September as they've greatly adjusted once again their forecasting, as they always do. I don't even know why we watch this anymore, guys, because this is the elite anyways. None of this matters. What really matters is you and I. And I'm going to tell you guys before I even continue, if you're out shopping for a house and we collectively said we are not going to purchase houses anymore, we would collectively crash the housing market, successfully reset prices, and get this over with if we just could come together. But regardless, 35% of the market is now saying a 50 basis point rate cut in September, while 64% of the market is saying a 25 basis point cut. On the bottom right, I highlighted the 6% of the market that thought we were getting a 50 basis point rate cut 1 month ago. The reason I'm doing that is you can't trust the market. They're giving you advice and opinions as if you were the top 1% elite. So if you're the top 1% elite, don't watch this video. What I'm really trying to say, guys, is it doesn't matter. What really matters is you and your purchasing power, what you're doing right now to prepare for a potential recession. But either way, you guys, let's go into some leading indicators in the market, starting with the 4-week rolling average median. Now take a look, guys. We're now at 389,250. Now you'll notice that we've had 5 weeks of decline. I'm going to start doing exact numbers here because Redfin, what I have found, is also revising the data on this chart. I'll get to that in a minute. But remember, we peaked at 395,999, almost 396. Now that black line, remember you guys, represents 2022. I'm comparing that because in 2022 we had deflation, we had prices go down that exceeded normal seasonality. So I think it's important to look at 2022 because what I'm saying is the leading indicators right now are demonstrating to us that we will have sharper price decline. Now right now in 5 weeks we're down almost $6,800, sitting at $6,749. Now I've said we're going to have nominal year-over-year price decline. What that means is we have to end the year under what I've highlighted right there on the left, 361,225. That's just to end the year with basic nominal year-over-year decline. And what I'm saying, guys, is we have more room to go. I also want to draw your attention to the week-over-week comparison because it appears that line is going up. Do y'all see that right there? From week to week, it appears that line is going up, but I just told you that we've had 5 weeks of decline. Now the reason I'm saying that is because they've revised last week downward $1,000. According to this data here, you guys, it's saying that the median sales price last week was and listen to what I'm saying, was 388,750. But if you remember last week's video and this article, it was actually 389,750. So what I've caught Redfin doing once again is manipulating their data. They've revised the data once again downward, and there's the proof. I don't like it, man. I mean, that's super shady. That's why you got to do your subdivision analysis. You can't trust these people. Despicable, man. I mean, you guys saw it yourself. It is what it is. Am I wrong? Are they not manipulating the data? Are they not changing the data? We are going to pick up the pace of median sales price decline because on top of unaffordability and inflation and quantitative tightening, now we're going to start shortly going into seasonal months of normal housing market price decline. So all of this is going to accelerate moving forward. And that's why I say it will happen generally until February. And that's why I'm saying someone's going to have to come to the rescue in February of 2025 because the housing market will not sustain without intervention. And even then, it's not going to sustain because house prices are maxed out when compared to income. Take a look at new listings, guys. We have our update. So it appears last week may have been seasonality because we don't have continued growth, or at least accelerating growth with new listings. However, we still have 4.5% year-over-year growth, sitting at new listing growth of 92,476. We don't know why those people are selling. We don't have enough trends to really know what's going on there. So we don't have that we still have the golden handcuff effect in the housing market. Those sellers still have not got off the sideline. And the other thing, guys, I'm about to show you is the buyers can't get off the sidelines. Supply is a measure of inventory and demand, and right now we're sitting at approximately 3.5 months of supply. Now, I want to remind you guys that in 2017 and 2019, we had 3.7 months of supply. So we are very close to having pre-pandemic, or even going back to 2017 level of supply. But remember, you guys, the housing market is bifurcated. Before I get into my 3 main leading indicators and we compare that to 2022, let's listen to another video, this time by George Bush.
Our system of free enterprise rests on the conviction that the federal government should interfere in the marketplace only when necessary. Given the precarious state of today's financial markets and their vital importance to the daily lives of the American people, government intervention is not only warranted, it is essential. In recent weeks, the federal government has taken a series of measures to help promote stability in the overall economy. To avoid severe disruptions in the financial markets and to support home financing, we took action to address the situation at Fannie Mae and Freddie Mac. The Federal Reserve also acted to prevent the disorderly liquidation of the insurance company AIG. And in coordination with central banks around the world, the Fed has injected much-needed liquidity into our financial system. These were targeted measures designed primarily to stop the problems of individual firms from spreading even more broadly. But more action is needed. We must address the root cause behind much of the instability in our markets. Mortgage assets that have lost value during the housing decline and are now restricting the flow of credit. America's economy is facing unprecedented challenges, and we are responding with unprecedented action.
Fed intervening in the markets only when it's necessary. Well, I think we're a long way from that. I think the target measures are really targeting the future of our children, because the reality is, guys, what we're learning and what I'm learning, especially working with Mitch Wexler, is my children are born bankrupt. Think about what I'm saying. That's awfully horrible. Let me know what you guys think the root cause of today's problem is. Do you think it's the Federal Reserve, fraud, corruption, combination of both? And then also, let me ask you this. What do you think the solution is? Our first leading indicator is active listings. So again, if you go into your local housing market, make sure you're tracking your subdivisions and track the active listings there, because technically the macro data doesn't even matter. But regardless, here's the macro data. We're at over 1 million, because they keep revising this, but we're at over 1 million. We've hit over 1 million going back now to June 23rd. We have growth of 18.93%. And I also want to remind you guys is there's a ton of stuff that aren't even on the MLS anymore. And this is not even counting new home inventory. New home inventory in some markets is even greater, just like my markets, is even greater than the inventory in existing, meaning I have more new homes for sale than existing. In Houston, Texas, it's insane the amount of new construction here. I mean, it blows my mind. We have a lot of migration. So I get to see multiple layers of the housing market because of my metro. The second leading indicator is days on market. And again, this goes so hyper local. There's some subdivisions, as soon as something comes on the market, it is gone. And then there's other subdivisions where listings are just sitting and rotting and collecting dust. But regardless, here's the nationwide DOM, which is well over 30 days. We're sitting at 34.5 days. That is an increase year over year of 5.8 days. So again, the longer that homes sit on the market, the better, because then that means that the sellers will have no choice but to cut the prices on their house. And the more in distress they are to sell, the more that you're going to see the last leading indicator, which is price cuts. And you guys can see that these price cuts leveled off above 7%, near all-time record highs, which again, this is demonstrating that sellers, whether they like it or not, and overall, not in every market, I'll acknowledge, but overall, have to rapidly cut the prices, and also remember, cut the expectations that they had to sell their overpriced house. In other words, purchasing power is shot, and demand in the housing market, as I'm about to show you, is absolutely a dumpster fire. And the reason why we know that is this. We can easily measure demand and interest rates by looking at the composite index, as you see here, and the 30-year fixed rate interest rate. Now, you guys will know back in May, we peaked at about 7.22%. Right now, we're all the way down to 6.47%, which means in that time frame, rates have gone down 75 basis points, which represents roughly 7.5% in purchasing power. And so if there was a ton of buyers on the sideline, surely a 75 basis point reduction in interest rate would cause them to come off of the sideline and flood back in the market, right? At least that's what we've been hearing for the last 3 years from realtors. But you guys, when we dig in further, we see that's far from the truth. I've highlighted in yellow right there, there was an increase. So it looks like initially, okay, rates went down, that yellow line represents the increase, but remember you guys, we gotta look under the hood, and this is what we see. The demand is coming from refinance. Look at this, guys, the refinance index compared to interest rates, it has absolutely exploded. Now, this is not a good thing. Now, this is, again, this is the 1-year look. You can see interest rates drop, and you can see refinance applications skyrocket. Now, that paints a horrible picture because what it means is, again, mom and pop are being taxed, and they have to refinance just to afford to live. Because think about it, what are they possibly refinancing into? From what, a 7.5 to a 6.5? A 1% interest rate change? That's it. We haven't really even gone into recession and experienced massive rate cuts. You guys, the fact that refinances are skyrocketing is not a good sign in the economy. And with mom and pop. This is also proven here when we just compare the purchase index, right, pertaining to purchasing houses, compared to the 30-year fixed. And you guys can clearly see, even though we had a massive decline in interest rates, demand at best has actually gone down, but at best has been flat, which means demand is absolutely dead. And one of the reasons why demand is absolutely dead is a massive amount of demand was pulled forward. They loosened up the guidelines instead of tightening up, and they gave lenders the ability to run something called automated underwriting. Because they gave lenders the ability to run automated underwriting, they took advantage of it, and they went over 43% and put a ton of people in harm's way of not having qualified mortgages. Now, if you're wondering why did they give lenders the ability to do that? The reason is professionals are supposed to be honest. Let's go back into the past, and I want you guys to listen to Alan Greenspan and hear how he was shocked back in the past to learn that bankers were stupid and selfish. Go figure. Listen to this video.
Mistake then. I made a mistake in presuming that the self-interest of organizations, specifically banks and others, was such as that they were best capable of protecting their own shareholders and the equity in the firms. And it's been my experience, having worked both as a regulator for 18 years and similar quantities in the private sector, especially 10 years at a major international bank, that the loan officers of those institutions knew far more about the risks involved in the people to whom they lent money than I saw even our best regulators at the Fed capable of doing. So the problem here is something which looked to be a very solid edifice and indeed a critical pillar to market competition and free markets did break down, and I think that, as I said, shocked me. I still do not fully understand why it happened, and obviously to the extent that I figure out where it happened and why, I will change my views. I mean, if the facts change, will change.
Things just aren't the same, but good morals and good spending habits are. And if you guys really want to be part of the solution starts with your empowerment and starts with your action. And some of the things that I think that maybe everyone should do is join the movement. Help us battle corruption and battle the central appraisal districts. I have a link to a petition in my description. Sign it. And on top of that, guys, empower yourself on how to purchase houses. I have made a free home buying course. It's in the description. I have no paywalls. Even if you guys wanted to pay me money, you can't pay me money except through YouTube, but don't do that, please, because they take money out of that. So it's just good enough that you share my videos, you like my videos, you comment on my videos, but regardless, you guys, I want you in the meantime to work on your purchasing power, your credit, your income, your assets, learn about cash flow and wedge and how to use comps, what subdivision analysis is. All you have to do is take the time to empower yourself, which is the start of the solution. Other than that, I hope you guys have a great Thursday. I hope it's not too bonkers. If you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.